Hello everyone. In this video, we will be working on a type of candlestick formation that professional traders attach great importance to and frequently use. This formation is called the double inside bar, and if used carefully, it can yield excellent profit ratios. The double inside bar is a significant candlestick formation used in technical analysis to identify potential turning points in price movements. This formation occurs when the price contracts within a specific range over a certain period and then experiences a sudden price movement, breaking out of this range. As the name suggests, it is defined using two nested bars. Let's now look at a few examples and learn how we can increase our capital in trading. Before we begin, please don't forget to subscribe and hit the like button. Additionally, I'd like to invite you to my Telegram channel, where I'll be sharing the trades I make in major currency pairs in a short time. The channel is currently open to participants, but if it reaches a sufficient number of members, I'll make it private. I look forward to your participation in advance. By the way, in the description section, you can find a referral code that will grant you a lifelong significant reduction in trading commissions if you create a new Binance account. Let's get started. In the first example, we can see the price action above the 20 EMA line. At the same time, a red-colored bar encompasses the highs and lows of the subsequent two bars. Here, we have a double inside bar formation, and we will watch for a favorable environment for a long position. On the screen, you see two different entry points for long positions. The first entry is based on the closing price of the first bar that passes above the double inside bar range in an upward direction. The second option, on the other hand, can be taken after the formation of a bullish engulfing candle pattern following a valid pullback move. For both entry options, a stop-loss order can be placed at the same level. In fact, traders who wish to monitor the trade for a long time in the upward direction may consider using the 20 EMA exponential moving average line as a trailing stop guide. And we can see that the trade has yielded excellent results. To take profit, one could wait for the price to close below the 20 EMA. Each bar closing below the moving average line can be used for partial profit taking. We achieved a fantastic profit rate of 1040 for pips. Let's add the CCI indicator to our chart. Here again, we see a double inside bar formation above the 20 EMA line, and at the same time, the CCI indicator confirms the presence of buying pressure in the market. When we draw the double inside bar range horizontally, we can see that this range is broken with a strong green-colored bar. This provides us with an opportunity for an aggressive entry into a long position. Traders who do not wish to enter the trade in this manner should wait for a valid pullback move, followed by a bullish engulfing candlestick formation. If we consider that we entered the trade with the candlestick that broke the range, then we would have captured a quite nice profit of 210 pips. Now let's look at a short position example. As you can see on the screen, the indicator is helping us by showing the double inside bar formation. We always mark the top and bottom of this range with horizontal lines, which is crucial for us. As you can see, the range broke in an upward direction. However, due to the price still being below the 20 EMA, we may consider the possibility of this breakout being a false breakout, and we will definitely not open a long position trade. Looking at the price action, we can see that there has been a desired reversal in the direction, and the range has broken downwards. Now, the conditions for our short position have been met because the CCI indicator is also below the 40 level, confirming the selling pressure in the market. After the price dropped 177 pips, it sharply reversed back up. Entering the trade on the breakout of the range resulted in a profit of 1 to 1.5 or even 1 to 2 ratio. In this example, I will talk about a very different scenario. We can see a very clear double inside bar formation on the chart. Once again, the downward breakout of the range gives us the impression of a false breakout, but it is important to follow the price action. And please pay attention here. After the first red candlestick that broke the range downwards, we see another red candlestick. This last red bar surpasses the high of the strong green bar that formed the double inside bar, rendering the double inside bar formation completely invalid. So, can't we open a long position in this case? Of course, you can. But the price action that has developed here led us to wait for the classic method of a valid pullback and then a bullish engulfing candlestick formation. If you observe the price action without considering the double inside bar formation, you'll notice that a valid pullback has occurred. As you can see, two different opportunities for entering a long position have emerged. The more a trader expands their strategy repertoire and improves their knowledge based on price action, the more flexible they can be in navigating market movements. For opening a long position, a CCI indicator crossing above 60 can also be considered as a confirmed entry signal. You can understand how wrong it would be to stick to just one strategy when you see the potential for fantastic profits here. Never rely solely on a single strategy, but instead, receive training on several models that you are fully proficient in and know to be highly profitable. I have been making backtests for years, repeatedly testing strategies that can achieve high profitability, and I strive to present them in the easiest possible way for you, of course. Within the limited time in the videos, it is not always possible to cover all the details. Therefore, please write down any questions that come to your mind in the comment section. And don't forget to join my Telegram channel. Goodbye.